Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Market Analysis on Tuesday, September 23, 2014. You're looking at a daily chart of the SPY, and we had another solid down day. Okay, so the SPY was down $1.14. That translates to about 11.5 points in the S&P. 116 points in the Dow and 19 in the NASDAQ Composite. All in all, it wasn't a big down day, but it was a down day nevertheless, and so our turn on the fall equinox did come in, obviously. Okay, so where do we go from here? Well, we came in today to the 50-period moving average. On the daily chart, that's the 50-day moving average, and that makes sense for a natural stopping point because you have, obviously, the 50-day, and then you have all this choppiness and consolidation going on in here from July, basically all of July. Okay, and it's right around the 197 area, give or take. It goes up, it goes down, it goes up, but it was basically pivoting around 197, 1970, 1972 in the SPY, and I remember that being a pivot point back then. So that makes a lot of sense. And let's put in a Fibonacci retracement and see where we stand now, okay? All right, there you go. So here we go. We're coming into the 382 retracement. We haven't got there yet, but we're really, really close. So I suspect, like I said last night, I don't think that this is going to provide a ton of support, because we basically were hovering around this area last time we came down, and I just think it's going to act as a minor level of support, if any, at this point. Since the 50-day we came into it, and it's right above that 382, I don't anticipate this being a heavy level of support. So I'm looking for the 50% or the 618, and that puts us down at, let's call it 195 to 196. This is our target zone for a bounce. Now, I think we may come into this tomorrow. And if we come into this tomorrow, I would look for an oversold condition bounce going into Thursday, maybe also Friday, and then we'll assess from there. And one of the reasons is that you have the Rosh Hashanah holiday coming up on Thursday, so you're going to have a lot of folks out for the holiday, therefore, and I think that goes the same on Friday as well. So therefore, that's going to translate to light volume, and when we have light volume, the market tends to be less down, even in an environment like this. So usually the market will float up in light volume, and we're due for a bounce, and so it kind of lines up. If we come into this zone tomorrow, I would suggest that we're going to get a bounce on Thursday, maybe into Friday. But we'll take it one day at a time. We'll see what happens. But that's my take in the SPY or the S&P 500 or the SPX, whatever your fancy. So we're going to remove this. And let's go over to the IWM. You know how I like looking at that when the market's moving one way or the other. See, this is much more weak than the S&P, and I want to show you something because this is interesting. You have a couple of things going on. So we have a trend line, okay, that if I take this pivot here, all right, and I come up here and I go through, okay, we broke that today. Now, we bounced off of it earlier in the day, but we broke it. And unless we pop over that tomorrow, you have two more levels of support in the IWM, and there's a reason why. Oh, maybe I got this still on. Here we go. Okay, so we got one, all right, and then we got two. Okay, now here's a story. So tomorrow we could conceivably come into this area about 110. Okay, and I think this is going to provide a good level of support here at 110. But if it doesn't, okay, and we proceed through, whether it's tomorrow or whether it's next week or Thursday or whatever it is, then this is going to be another good level of support. 107.5 to 108. You know, we might not get down all this way because there's a lot of pivots in here. So the market could easily stop at one of these other pivot lows. And that's probably more feasible because it's always the market's job to fool us. If we think it's going to come in to a double bottom, it won't, and it'll stop short. So I would say that, you know, in this area, 107.5 to 108 is probably a good target. And, you know, you give yourself a little wiggle room if you want to play long. You figure, well, it still could go down another 50 cents to the double bottom. That's not that big of a deal. So that's my take on the IWM, but I would expect a pretty sharp bounce. One of these levels is going to give a pretty sharp bounce in the IWM because it's very, very oversold. It's very weak, and there's probably a lot of shorts in here. And when the shorts start to cover, this thing can go up in a hurry. So you'll get a 2% day out of this thing if we get one of those days, or 175, 2%. So don't be surprised if that happens. So there's your support lines. I should actually draw another one in. I'm going to draw one more in here. It's probably too many support lines to think about, but I think it's important enough. So you're going to have, you know, the trifecta, you know, first level, second level, third level. So this is kind of I would say this is a yellow light, you know, green light, double green light. That's pretty much the way it is if you want to play a bounce on the IWM. Now, I just want to take a look at the Dow, which we normally don't take a look at because it's not really that important as an index. It's 30 stocks, and they're really, you know, heavy, large cap, price-weighted stocks. But here's the story. The reason I want to take a look at this with you is because the Dow is significantly less weak than certainly the IWM and the S&P. So one of the reasons for that is because money tends to hide in the big, you know, Dow-type stocks. Your Altrias, your Coca-Colas, the Visas, those Exxons, even though Exxon's weak with the oil sector. But those stocks tend to attract money when the other indexes, the growth indexes, are headed down. You know, money looks for a place, and the Dow is one of them. The bond market's another. But that's what happens. So you've seen a rotation as the market started to get weak out of those other stocks and even into the Dow. And the Dow was significantly stronger than the other two indexes. Look at the new high the Dow made as compared to the S&P and the IWM wasn't even close, right? The Russell. So I just want to point that out, that if the market doesn't really sell off, then the Dow could find some support in here at around 17,000 and bounce back and continue back up. So you need to be aware of that, and I just wanted to bring that forward because it's important. I mean, it's not even close to being in a downtrend, right? There's nothing wrong with the Dow. Look at this thing. It's just going strong. And if we take a look at the S&P weekly chart, well, let's look at the SPX weekly. It's the same thing. I mean, on a weekly basis, these indexes are strong. So you have to be aware that on a weekly basis, okay, this 1960 level, which is the 20-period moving average, it's not going to be a ton of support, but it is going to be support. So we need to be aware of that. And let's go translate the 1960 over to the daily chart on the S&P, and well, let's look at the SPY. I know this is drawn out, folks, but I think it's important tonight because we're in a critical juncture here. So let's go back to the weekly, all right, and let's pick out the 20-period moving average. And what do you have? 196. Well, if I go back to the daily, all right, where's 196? 196 is here. I want to draw the fib in one more time, and let's just double check where the 196 is. Okay? Here we go. 196 is 50% retracement, so we could pierce it, okay, down to the 618. All right? That would be by about $1, all right, which is about 10 points in the S&P. Pierce it and then come back above it. That can certainly happen. So for example, if we don't get a weekly close this week below that level, okay, the market is technically still in an uptrend. So you need to be aware of that. And that's why I wanted to bring all this back, is because you need to be aware of where the uptrend is and is not on a weekly basis. That's important. By Friday's close, if we're below that level on the 20-period moving average on a weekly basis, that puts the market in a very weak position. Okay, so we just need to be aware of that. All right, let's move on and let's go over to the gold market. All right, let me blow this chart back up. Okay, so with the gold market, we had a bounce as predicted. Okay, last week I told you guys where the bounce level would be, and it did come in. So I think that there's more upside to be had, and I think, you know, a natural target would be around 119, in that neighborhood, around 118.75 to 119. All right, and the reason for that is over here. All right, you had this big red bar, and it's going to be tough to get through that unless you can do it on volume. And that day, there was 8.3 million shares. What? Wrong day. No, that was right. 8.3 million shares on this day on the downside. So you really, in order to get up there and pass it, you really need to pass it on volume of more than 8 million shares, or else the likelihood of doing it goes down. So that's just something to be aware of. This is the GLD. The target on the actual futures gold contract itself, or the gold futures contract itself, I think a good stopping point, profit point if you're long, is 1240, maybe up to 1250, but I wouldn't wait that long. I would say 1240. If we go higher, we go higher. You can put a trailing stop in whatever you're playing, or just move your stop up as time goes on. If you're in this trade and you're positive, which you should be, then please don't make it a losing trade. So put at minimum of a break-even stop or an in-the-money stop at this point, and then trail it up as we go. Next on the docket, let's take a look at USO. That's gold. USO. Okay. USO got a little bit of a bounce. Oil got a little bit of a bounce. But, think about this for a second, folks. So you have all this stuff going on in the Middle East. Okay, we started a new military campaign in Syria. You have just pandemonium going on in Iraq. You have all the other Middle East conflict stuff that's always going on in Israel, and you have Iran is always a wild card. Then you have Russia and the Ukraine. You always have a wild card with North Korea. I don't know if that affects oil, but nevertheless, they're always a global wild card. They're always going to launch a missile sooner or later. And all this stuff going on around the world, and yet, the bounce in oil was nothing. It was just nil. Where did oil finish today? Oil futures is currently at, this is the November contract, 91.50. Okay, we were down about $1 lower yesterday. So the best we could muster out of what's going on in the Middle East, the new fresh stuff going on in the Middle East, is $1. And we're in a downtrend. So my take is that oil continues lower. Whether we see a bounce for another couple days or not, you never know. But certainly oil continues lower, and I'm sticking by my price target on the price of crude of around 85, give or take $1. And I think we can get down there in October. So if you're short crude, stay short crude. If you're not, you can get short crude. So that's my take in that market. And I want to look at one other thing tonight. I know this is a long video. I'm sorry, but this is important stuff because the markets are moving and you can profit from them. Okay, so this is the TLT. This is the 20 to 30 year bond proxy. It's an ETF. Okay, and you came into this, we'll call this a necktie of the 20 and 50 period moving averages, okay? And that's a natural stopping point, but it's been strong the last 3 days off of this doji candle here after this big down move. Okay, so where to from here? Well, one of two things is going to happen. Either this is going to repel, the necktie is going to repel back down, and that's unlikely if the market continues down, the stock market, right? If the stock market continues down, right? Right now, this is a mirror image of the stock market. 3 down days in the stock market, 3 up days in the TLT, 3 down days in the interest rate market, okay? Mirror image chart. Let's go over to the 30-year, and I'll just show you that. The chart looks very similar, right? So interest rates going down. Let's go back to the TLT, all right? Now, if we have a significant down day tomorrow, this is going to spike. And once it starts to spike, I think that this gap window here is going to act as a magnet at 117, let's call it 35, give or take, okay? Call it 117.40, you probably pierce it a little bit. But either way, if we get up here tomorrow, okay, if we get up here tomorrow, this is a stone cold short. All right. Now you can short the TLT, or you can buy the TBT, which is 2 times inverse the TLT, essentially, right? It's 2 times inverse the long bond. Okay, that's what this is. So if interest rates are rising, the TBT is rising. If interest rates are falling, the TLT is rising and the TBT is falling. So interest rates have been falling, TBT has been falling, and this looks like a mirror image of the TLT chart, right? I hope that's not confusing. So if we get down to this area, which is the same gap window that I showed you on the flip side of the TLT, this is a buy. So you can say that 55.5 is a good level to pick up the TBT for a trade. Now, you have to be careful with this. These double long and double short ETFs, you have to be careful with them. These are day trading vehicles. These are not long-term holds. So you can hold, when I say day trading, preferably within intraday, but you can hold these a few days, no problem, but don't hold them for weeks or months because they deteriorate because of the way they're constructed. They have futures contracts that they have to roll over, and there's a cost to do that. It's the way they track the market it's tracking. There's a high cost associated with it that deteriorates the price, and it's called slippage. And so the price slips. So it's not a true proxy, but it is when the particular market is moving, especially on volume and on velocity. They are good vehicles. So for a day, 3 days, 5 days, they're okay. Any more than that, I wouldn't recommend holding these things. Okay. So I'm going to wrap it there tonight, folks. I know it was a long video, but it was an important one. There was a lot of information. Markets are moving, and we need to be aware of what's going on. So I'm David Frost, mystrategicforecast.com. This was another episode of Common Sense Market Analysis. Thanks for tuning in, folks.